You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
And hello, everybody, and welcome to the Option Block. This is your show, your weekly roundup of option, or actually bi-weekly roundup of options news, activity, strategery, anything related to options that we could think of that is interesting to stick in a 1 hour program. We will do it here at the Option Insider Radio Network, part of the, I guess it's just part of the larger Option Insider Media global conglomerate that is growing by leaps and bounds every week that the market stays open, because as long as we have something to talk about, we're going to fill our shows up with all of that information. And today, this is me, Andrew Giovinazzi, Chief Operating Officer of OptionPit.com, trying to fill the massive shoes, the big, the large shoes of Mark Longo, who is, guess again, at another conference in a sunny location somewhere in the United States. But lucky for me, I'm not by myself. You just do not have to listen to me, the Rock Lobster. You get to listen to somebody from, just let's say from a nice place, somewhere in the Midwest, somewhere bucolic, somewhere by a river, I don't know, somewhere in the middle of Illinois somewhere. Yeah, I think it's Mike Tosaw from RCM Wealth Advisors. Mike, how are you doing?
I love that introduction. It's so nice to start a show without having to claim umbrage on the host for spreading more lies about my beloved hometown.
Oh, my gosh. It's like every show. Something about, my gosh, something about that lovely hamlet.
I don't understand it. I mean, I think he has to live in Chicago. I mean, I don't have any qualms against Chicago, but I mean, he always is saying bad stuff about Maine and St. Charles. I don't know. Maybe we should make this the umbrage hour. Since we're running this show, we're going to call this the hour of umbrage, I think.
The hour of umbrage? Even
yes.
Without Longo here, we'll find a way to claim some sort of umbrage. I mean, considering all the problems Chicago has, I mean, what problems do Maine and St. Charles have? Nothing. There's no problems here.
No.
I think it's just they're just quiet places. I think Longo needs the action. He needs the city action. Maybe it's the old trader in him. He just can't be too far from the CBOE. He feels like he has to be able to look down LaSalle Street and see Ceres on the top of the Board of Trade building and know that he's still within a stone's throw of his old stomping grounds.
I think you're right.
Well, I think that that starts our introduction. We now know who is here, and we'll move right into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody, and welcome to the Trading Block. This is the segment where we run down all of the activity. Well, actually not the activity, but what's kind of happening, news that's breaking, what's lighting up the screen on a day where, oh my gosh, The realized vol might have actually gotten lower today if that's humanly possible or possible for the market. But we do look at all that stuff. And I guess, I could say, I'll just ask Mike first. Actually, I have a pressing question. I was just talking with Gene. The BBI, if the BBI is high, does that mean you actually can leave your desk easily? Or that means you're stuck in front of your desk and you have to wait till the end of the day? Which is it?
I think the BBI being high means that I'm stuck at my desk.
Okay.
Our beloved host came up with that index many years ago, and I believe it's a high BBI day means that I can't leave because it's that exciting.
Actually, Gene guessed that. That's that's good. So let's just stick with this because this is the Umbrage hour, and we're just going to do what we want.
Darn right.
And so, if you had to say, was today a high BBI day or a low BBI day for you?
It almost became one. When we were around 1 o'clock today, when the S&P dropped, SPY got down to 235.74. It almost became one. I will say that, but it did not. We actually rallied back, and we obviously didn't have a very big up day from the start. But it was looking. How do I put this? The BBI VIX became very high for a moment.
So there was a flutter. There was a possibility.
There was a possibility. Yes.
I know we were looking. I was looking at some like put spreads we have. Like, okay, this is going to be our big shot to sell these. This is it. I'm going to make like 2 cents on these. Not a very exciting day. So if you're looking at the market, you're looking at today. We also have one of those strange confluence days where we had market up, VIX up on a Thursday, which is, it's a little odd. I think, the habit that we've seen lately is marking things down early in the week because realized vol is so low, the liquidity providers just cave everything in. So if you see VIX up, is there anything that's happening today that kind of gives you a little? Why would volatility, VIX be going up today? What if you had to just throw something out there for a reason, Mr. Tosaw? What would that be?
I would say fear of tomorrow's news with the unemployment report or non-farm. I would say that's the main catalyst for the VIX coming up. I mean, there were some other things that were happening today, but I really don't think that the Trump wiretap case or oil continuing to go down, I don't think that that's what would drive it up. I just think that there's buyers of premium ahead of non-farm tomorrow is what I'm thinking. And I kind of think it's going to be a resounding meh, but we can talk about that more at Around the Block.
Right. I think I'm not disagreeing with you on that. It does seem like since, as I recall, when Washington's locked up, the market usually likes it. I think Washington's being locked up for different reasons, because everybody's just throwing accusations at each other. And it feels like we had sort of a bit of a rally last week. And we had some momentum, and then everything sort of stopped. The momentum of the market stopped, and everything just sort of. And I think part of that, maybe there was a lot of expectation built in, and now, there is things coming out, let's say, on healthcare, and maybe they're arguing about taxes and all of kind of the things that we thought would make the market rip. It's just not happening I guess it's not happening as fast or as much as everybody would like. So I think that it could be something that kept the market from moving up. Also, oil slid this week, kind of a surprise, big inventory number. And a lot of oil related stocks just got, shellacked. Oil got shellacked a little bit. Everything was down a little bit today. Not huge, but, enough. So I look at those things and I'm like, well, I mean, it's certainly enough to have some volatility. But the thing is, VIX is up 46 cents to 1232. It's not like we're really seeing a whole lot of activity.
Right.
But the next thing I have, which I think this is some of the biggest news, especially for me as an old market maker and watching Timber Hill, with only one console when I started in '89 on the PSE, which I guess is now the PCX, it's now part of the NYSE. But Interactive Brokers is going to stop their market making activity. Their old group Timber Hill has a lot of traders all over the place. Ex-Timber Hill traders are everywhere. Ex-Timber Hill trader started LiveVol. They are far and wide. They're the people that, manage those consoles on the floor, trading for them. They have been there for forever, 25 years. Let's see, how long I've been around, 25, so 30 years or something, a very long time, at least. So what do you think about that they're actually decided to stop their market making operation and go and just commit fully to online brokerage?
I think that's really big news because Timber Hill, I'm just growing up in this business. Timber Hill is just something that it's hard to go a week in this business, even if you have nothing to do with Timber Hill, without hearing the words Timber Hill in one way, shape, or form. So just because of the size alone. So I think that's very big news. I don't know if I'm necessarily shocked by it, but I'm going to be curious to see where that all goes because, it's a very big player that's not going to be playing anymore.
Yeah, I can't imagine them leaving the marketplace is going to be good for liquidity, and this is a trend I don't like, because of the way order flow kind of gets sold in a block to different places, and ultimately, a lot of retail traders they see markets that are only a couple cents wide, it's hard to argue with that type of liquidity and that kind of that's price spread. All our clients are all retail traders, so us even running the fund, although we do our execution is mostly hand execution, but the old-fashioned way. But it is very it's hard to argue that customers aren't getting pretty good fills from the current system. But also, it sounds like they don't want the regulatory headache of trying to separate a market-making arm from a brokerage arm. Does that sound, reasonable or no?
I would think that's very reasonable because if I'm a regulator, and it must have just been a huge headache for them in a lot of ways. And spinoffs happen all the time with companies because if there could be a potential conflict, that could be there. Now, don't get me wrong. I think that Interactive Brokers is a legitimate company. I can't say I always like their customer service dealing with them through the years, but I think I don't think they're a corrupt company or anything like that by any means. But if I am a regulator, that is one of the first places with which I'd look. It's kind of like two analogies of that. RCM, I probably work with options the most. And whenever we get audited, I always say, well, okay, they're probably going to come look at me first because they see the word option. And, who does the most with options? Well, it's me. Everyone does it in some way, shape, or form. Then the other one, it's like I think that really big comedian a few years back, John Panette, he said that, I'm going on an airplane ride. And they say, oh, wait, it's kind of we might be at our weight limit. How much do you weigh? And he replied, if it's that close, I'm not going, because if the plane starts to go down, they need to unload weight. Guess who they're going to start looking at? And so I think in this way, by having this arrangement to regulators, and this is just speculation on my part, they're kind of the John Panette on the airplane, if that makes any sense.
I think it does make sense. I was trying to read the article. I'm guessing they're probably going to sell their electronic market making business. The infrastructure they must have for that is, I can only imagine that somebody's going to be interested in it. It wouldn't surprise me if like Goldman snapped it up, or Susquehanna. I don't know, some of the other still big market making firms, or Citadel snapped it up. Who knows? or a hedge fund that just wants to look to get into the business. Because it's sort of, I'm sure that guy is probably, if he's not the smartest guy in options, he's the second smartest guy in options.
He's not dumb.
He's not dumb. So I would assume that he will still come out okay. It's not like he's poor by any stretch of the imagination. A billionaire probably a couple times over. So anyway, with that, the next thing is, but anyway, that's a milestone. Just a surprise for me. The next one is Snap.
Crackle pop.
This is another one where I get, but I don't get the valuations on these things. I never really have gotten internet valuations. And ultimately what has happened is internet valuations eventually become normal valuations. The only one I think that has consistently been able to avoid reality is Amazon. I think Amazon continues to grow, but they've never made the big dollars that, I think, what did Amazon listed in 1995 or 96 maybe? It's a 20-year-old company now at least, and they have always managed to sort of defy expectations. Although the stock did, I remember at one point, what was it? I think it was down to like $12 or $13 in 2002. So I realize that's a long time ago, but that's not a lot of money considering where it's trading right now. I would say reality hit Amazon then, but I mean, it's grown and grown and grown and everybody uses it. But Snap, 20, what are they getting? A $30 billion market cap for this thing?
Yeah, it's up there.
So as Longo would say, is this on your list of things for on the double secret RCM Wealth Management Fund? Is this something you're going to throw clients into at this? Maybe this is a very reasonable valuation for Snap.
Well, I do have one client that insisted on just being a part of it a little bit, and so he does own 50 shares. He just wanted to have some skin in the game, and he couldn't resist. So we saw it go up the first couple days, and we got in the other day. What did we get in at? We got in at 21.31. So we let it come down a little bit. So far so good, but it's a whopping 50 shares for one client that really wanted to be a part of it. And aside from him, I don't really see that coming to fruition in a more serious trade. We'll probably be out of that trade in the near future too, but just for a little something fun. But in reality, it's up. Let's see, it's from 21.31. It's it's up over about 5% in 2 days. So hey, let's have some fun with it.
Yeah, it's something. We were just trying to figure out pricing, what the a 30-day straddle would be. What's funny is if the vol was a little over 100, that 30-day straddle would be $5.
Okay.
Which is not nothing. A 75 vol would be about $3.50. I thought it would probably, like $3 for maybe a 30-day straddle would be reasonable, but it looks like it's kind of cheap relative. So we'll see. So my market's 3.5 on the 30-day straddle. If I had to make one right now, at least it's easy to make one when you're talking on a radio show. The last thing I would say is oil falling below $50. And I know that you have an XLE position. It's way in the black, but is it making you think about adding any more to that that near bottom scoopage that you performed last year with oil kind of drifting back a little bit?
Oh gosh, I'd love to. If I wasn't, I don't have the. I mean, you can always make more funds too, but I don't have the funds that it would screw up my allocations if I added to it at this point. But there are times to where if I were to get a new client and they were to say like, what would be a good opportunity right now? If I was in cash, I would definitely want to add some XLE to this position. I mean, oil itself, I'm just looking at this over the course of the last week, just crude itself. So let's look at last week's close on Friday. Closed at 53. What do we have? 53.20, and it's down at $49.20 right now, $49.26. So that's $4 over the course of a week, or not even a week. We still have another day. So we could get, if we come down again tomorrow, we could be down about 10% in 1 week with crude oil. And so with that being said, I think that's a little bit overdone. So I am viewing this as a buying opportunity. And if I were a futures trader, which I am not, I would definitely be looking to buy crude at this point.
It looks it's odd. Oil is it's fickle, but it hasn't done a whole lot. And I was looking at, okay, so now all of a sudden OPEC it's almost like maybe all the oil people got together and said, well, okay, OPEC, you start maybe, because they were increasing production into the price coming down, trying to squeeze all the shale people. So maybe they came to some sort of accommodation about mutually assured destruction in oil prices. But anyway, I think those are for what I would say is the SPX was up 189 today. That's $1.89. So realized vol is basically zero in the index. So we managed to find some kind of news on a slow day. But I think that will do it for the trading block, and for now, and then we'll move. It's time to get funky and take a look at the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the odd block.
All right, everybody, and welcome to the Odd Block. This is the show where the strange, the large, and sometimes downright head-scratching paper, also paper sometimes that Longo and I think no chance that could ever make money, and somehow, miraculously, it does. So things can always happen that are statistically not probable, trading options, which is something probably Tosaw and I both understand. Which is why you have risk control, of course. But today we will be looking at a few stocks. And you got the notes, Michael. I don't know if you want to come in. I do. What I do is I will ask you if you know anything about these stocks at all before I start. So the first stock is ILG, which is ILG Incorporated. And what does it do? Have you ever heard of this name before?
Let's see. No, I have not.
Well, I'm going to do the Longo and just say ILG. Although this is a Longo stock because the name of the company and the symbol are the same. So I know I don't want to make it too hard for him. I don't want to have him stretch.
Oh, he likes it when that happens.
I know. I know he gets very upset when the symbol and the name of the company are different. It totally upsets the apple cart for him.
He stays up late at night and stuff like that.
You would think after 500 episodes or something, he would be able to
We're at 600. I think we're at 600 now.
Are we?
I believe we hit the 600 mark recently.
That is a milestone. Like there's very few things that are 600 of anything, to be honest. Yeah. But anyway, so ILG, it actually is a leisure company. I think it's kind of a timeshare type thing, hotel type thing. Not quite sure exactly, but it used to be Interval Leisure Group, so they paid somebody a lot of money to change the name to ILG, and they deliver professionally delivered vacation experiences, whatever that is. I have no idea, but anyway, it's somebody that delivers vacations to people, or they set up vacations, I guess, but. Anyway, the stock is trading 1827. It's near the top of the 52-week range. And what traded today was 2,975 of the April 17 puts for 15 cents. So I look at a trade like this, and my first reaction is always, is this a line in the sand type of trade? Meaning, somebody wants to own the stock at 17, and so, they sell the puts and they find a buyer, and possibly they take delivery, 3/4 of a point lower than we are. When I did look at this, it looked like the earlier trade was actually a Jan-April put spread, which it looks like the person purchased, or the trader purchased, and now they're trying to close the April 17 puts, as far as I could tell. And the reason why would be, you trade 32,000 puts, which is the eventual volume, and they're still offered at 15 cents. So my guess is, the initiator was a buyer, and then there's still all you want at 15 cents. So that's what I would think of this particular trade. So they probably made money on the short, but they're still sitting on a bunch of, I believe, the open interest on the Jan 2018 17 puts is 31,000. So it's kind of sitting there. I don't know if you have any sense about this particular trade. It just, to me, it looked like a chime spread close, or closing the short leg of the spread, which gives them a lot more room, obviously, in case the underlying moves. There was also some activity in the September 15 calls, which were kind of in the money. So to me, okay, if they're closing out of the short, and it's possible that they're buying Sep 15 calls, they're basically trying to create a giant. They're trying to create a giant synthetic call, because if you're long, it's kind of a synthetic straddle. You're long a put and you're long an in the money call. I think you're kind of hoping for the stock to go up, or if it doesn't go up, you're long a lot of puts that you can sell. So I don't know. Do you have any sense of this leisure, this let's just call it the lazy leisure stock, ILG?
The lazy leisure stock. No, I think that seems about in line. The only other thing that I could think of, but this is a total stretch, which I actually doubt, is that perhaps it's a ginormous hedge fund with portfolio margin in some way, and they are trying to free up some buying power because they had it as a stock holding, and this would free up some buying power for them.
Yep, it could be.
And that's a stretch. That's a major stretch, what I'm saying. But that's the only other thing I could come up with.
I thought that was nice. It was a well thought out stretch. I'll tell you what, it's a better stretch than Longo would have done.
There you go.
Because he's
claim
not
some
here.
more umbrage on him. It's been a whole half hour. Let's claim some umbrage on Longo again.
let's claim some sort of upsetness that he once again is in a tropical paradise at a conference. I still conference. What is he conferencing? What is he actually doing there?
And why
He's
has he never
walking
come to
around-
our towns of Maine and St. Charles?
Exactly. Where's the St. Charles conference? It's always, it's a sunny tropical paradise conference, where we have really tall mixed drinks and we go talk to each other. That's kind of what I'm sensing with this conference. But anyway,
We'll come back to that in 10 minutes when it's time to get our umbrage quota in.
exactly, when we have to get upset again. All right. So, and then he makes us host the show. Oh, guys, I'm not going to be there, but you guys can host the show. He really gets away with a lot, I think. Don't you think so?
He does get away with a lot.
Okay, I want to make that clear to all our listeners. All right, so anyway, XES is the next one. It's the Spider S&P Oil and Gas ETF. This ETF actually looks at oil and gas equipment and services part of the industry. Today is down around 34 cents. Near the middle of the 52-week range, and this is another one getting shellacked. This oil is kind of a story. It was kind of just, it was kind of meandering around $23 and it sort of fell off the cliff. With the price of oil falling, all these things kind of move in sync. Here, though, I thought this was an interesting one as far as trade goes, where they traded spread 5,000 by 7,500 of the March 19, April 21 put spreads for $1.28 over 61 cents. So what happened, I think, was is they own the March 21 puts, and what happened was they made some money on them, or they're long stock and long put. And I think when you own puts, you have to roll them. To me, it's kind of one of those things where, okay, I buy puts and I buy stock, and if the stock goes down, you either have to roll the put, and assuming the stock goes back up at some point, because if you just own the put and the stock goes down and the stock goes back up, there's no point in owning the put. So you have to kind of continually to harvest the dollars in the put, and at some point you figure the stock might go up, and then you make a bunch of money. At least that's the way I think about rolling puts. And I think this customer did too, because they went from 5,000 of the March 21 puts to 7,500 of the April 19 puts. And the open interest in April was zero, literally zero contracts. The open interest in April total for this product is maybe 150, 200 contracts, so not much. This person seems to be the only player in town. I don't know what do you think is so? This is kind of back to what I was asking about XLE and the XLE thesis. Do you think this person's kind of taking their dollars and moving on? Would be my question for you, Mike.
Yeah, that could be. I mean, it's a ratio roll though, going from 5,000 to 7,500. So that does kind of make you think that it's a house money roll. Meaning you're playing with that, you want to continue to play and have it with the house's money. I would say that does make sense to me.
I think so too. And they're either they own stock and they're rolling it down, but usually when you roll for more, when I see volume that goes from a smaller number to a bigger number, they generally don't have something against it. They're just, oh wow, I made a bunch of money. I'm gonna take that money and roll it down and see if we can follow it down. So they're not leaving. It is also obvious. It is possible too that there could be some stock against it, and they just want more puts against the position. Now that maybe that put protection is more than paid for. And lastly, and this is something that I follow. That I've been adding positions to this for add a little more today. But XOP, which is it's the oil and gas exploration and production ETF. So similar to the XES, I mean, same, different part of the oil industry. Today it was up actually a quarter after it was down a couple dollars yesterday. And we highlighted some unusual activity in it in the website yesterday as well. Somebody actually sold, Mike, the 37 puts for 15 cents yesterday, about 30, a huge amount yesterday. It did not go very well for them on that particular transaction. By the end of it, I think they were buying them back. But anyway, at least today for XOP, here was the trade. It was a spread. It was 10,575 of the Jan 35 put spreads over the 42 calls. The put spreads traded at $1.98 and the 42 calls traded at $1.84. Now this product trades around 76,000 contracts a day. The open interest on the trade was the put spread was 9,000 contracts over 36,000 contracts, and the calls were just 3,400 contracts. So, I mean, it's possible that the 35 puts got rolled to the 30 puts, meaning somebody bought in the 35 puts and sold the 30 puts. But also the way it priced, things kind of hitting the bid, they sold calls. So if they were rolling down, they'd be short a strangle, as in short the 30 strangle and short the 42 calls. So, I mean, it's possible to be a short strangle like that. I did see a pretty huge block of stock go up. About 10 minutes after the options traded, 400,000 shares went up, which would be, I would say, approximately, but not exactly, approximately delta neutral. But it would fit the thesis if, I want to buy kind of a delta neutral back spread. This XOP is down here. I'm going to buy a put spread against the underlying, and then I'm going to write calls on top of that. So that actually sounded vaguely like sort of your Apple strategy from the old days, or maybe one of your gold strategies where you sort of bought puts or put spreads against the underlying, and then you would write calls. Does that ring a bell back in the Tosaw archives for, doing stuff against an underlying position?
It does. It also rings a bell in what I'm currently doing in a lot of ways with hedging SPY, using a put spread and selling a call spread, and just kind of a modified collar type of thing. I hope this trader is doing something like that, because, man, I would not want to be short a strangle right now in the energy field at all, especially for January of 2018 is one of the short strikes. So I am hoping that your theory is correct for their benefit.
I hope so too, because I'm looking at the 1 year volatility for the thing, and the 1 year volatility is it's at a 2 year low. It's not exactly at a dead 2 year low, but it's a couple points from there. So as we have seen what can happen to these products, this literally, they would be selling the first pop in volatility if it was. It could work, but it could also be extremely exciting in the meantime, as you well know.
Extremely exciting. I don't like exciting when there's excitement's overrated.
I like, what I like exciting? Fishing. That's when I like exciting. I throw the fish line in, fish hits the hook, and I try to reel it in. That's excitement I could deal with.
I can too. So I guess let me rephrase that. In trading, excitement's overrated.
Exactly. I had plenty of excitement as a floor trader. Now I just, I try to manage things on somewhat even of a keel. But, when you're trading just looking at the screen every day, I mean, how excited can you get anyway? All you can do is yell at the screen. So how that actually adds no value at all. At least in the old days during the floor, you could yell at some some other trader you didn't like anyway, so you could yell at them just when you had, having a bad day. Now, you just kind of you kind of do that on the screen, and then you have to move on. So it's a lot more sterile and not quite as fun as it used to be, but at least Very I have true. This show. And normally we have Longo to make fun of on the show, but today...
Hey, it's been 10 minutes. It's been 10 minutes.
So, but you know what? I think I'm pretty sure, but that's my cue for the strategy block. So we're going to close the odd block, and is it time for a smoking jacket and a pipe? And Mr. Tosaw will give us some strategery on the strategy block.
It's time to dispense options wit, wisdom, and education. It's time for the Strategy Block.
All right, everybody, welcome to the Strategy Block. This is where Uncle Mike comes down from on high, and we benefit from his wisdom on the strategy and how he manages stock and option positions. And with that, all I can say is just take it away, Mr. Tosaw.
I am excited to be here on the Strategy Block. Today I want to talk about the first thing that I want to do is I want to just bait some good-natured umbrage from the option pit. I'm going to say the word that they hate, credit spread. See, I knew that would do it. They hate it just because, and rightfully so, because oftentimes a spread that you are short is pitched to people as, well, I like credit spreads over debit spreads because on a credit spread, you get money coming in, and a debit spread, you have money going out. That's just the way I like to roll. When in reality, the risk reward is the exact same thing, but that's just kind of the way it is. So, but what I want to talk about is when a credit spread when you're trading something that you are trying to collect premium on, a short spread, when it becomes a long spread based upon the movement of the market. Now, let's take an example. Let's say that XYZ stock is trading at $100 per share. And I shorted the 95 put, and I bought the 90 put. Just an old-fashioned short put spread, also known as the bull put spread, also known as the credit spread, but hopefully Andrew's on mute so we don't hear his blood-curdling umbrage with that. Oh, no, he's not on mute. So in that case, at that point in time, when the short put spread is out of the money, you have time decay working in your favor, meaning that every day is a victory based upon theta. Now, of course, volatility could go higher, and you could have the stock also go up and volatility go up at the same time and still be at a worse place in the pricing of that spread than you were the day before based on volatility. But let's assume constant volatility for the sake of example. If that's the case, then every day is a victory because you're one day closer to expiration, so long as that spread is out of the money. Now, here's something that a lot of people have a hard time with. Once you get in the money with that spread, let's say you took $1 as a credit from that spread. Once that spread goes down to, say, $91 a share, or once the stock goes down to $91 a share, well, at that point in time is no longer on your side. Time is on your side. The simple way of looking at it, excuse me, is that time is on your side when you can look at a spread and say, if expiration were today, would I be better off or would I be worse off? Because if the stock is at 95.01 and you have the 95.90 put spread, then if that's the case, time's on your side. Because at expiration, you'd be better off because that would expire worthless. Now, of course, hopefully you get out of the trade before expiration, like we've talked about on this show at least 600 times now, I'm convinced. But that's the way with which you want to look at and analyze the current trade with which you're in. Once that goes in the money, more than the initial credit with which you received, then time's no longer on your side. So let's say you took in $1 for that 5-point spread. Once that trade, or once that stock goes to $93.99, a penny below the credit point, then time is not on your side, because at expiration, you're going to have to be assigned to that stock, and you'll lose $1 on the stock because you'll be assigned at a higher price, and you only took in a $1 credit. Now, it's not quite that clean in real life. There's a lot of other risk involved and that type of thing. But I want to just kind of give you an idea to where I've talked with people in the past when a credit spread is totally gone against them, and they're like, well, but I got time on my side, so I just want to wait this out so that way we can get some time decay. Well, no, time decay doesn't help you once it goes below a point. So that would be a case to where a credit spread would become a debit spread in a hurry, and time would not be on your side. Now, it doesn't literally change credit versus debit or the options change. I'm just talking about there is a point when time decay no longer helps you. Now, let's look at it the other way. When you have, let's say you buy XYZ stock is at 100, and you buy the 100-110 call spread. Well, once the stock goes above the 110 level, at 100, time's not on your side because you bought at the money. Now, yeah, you had the short 100-110 call that's helping you out a little bit, but if you were to hold everything till expiration, you would be a loser on that trade if the stock were to stay exactly at 100. Once the stock goes above where you paid for the debit, it becomes a trade where time decay is on your side. So, for example, let's say you bought the 100 call for $10, you sold the 110 call for $5, and you have an overall $5 debit on this call spread. As soon as that trade goes, or the stock goes to 105.01, $105.01 per share, time's on your side. That means that at expiration, you have the ability to exercise your option at 100, and the stock's actually at 105.01. You paid $5, and you have a $5.01 gain. So at that point, it's a different dynamic, and you need to manage your trade accordingly. So the moral of the story today is that if you do have a trade that you are in, a vertical spread, whether you're trying to receive a credit or you're looking for movement on it and you're trying to gain from movement of the underlying, well, if that's the case, then be mindful of what's going on with everything and manage your trade accordingly. And last but not least, do stuff. And that's the strategy block for today.
It was a lovely strategy block, Mr. Tosaw.
Why, thank you.
You know, it's much better when Mark's not constantly interrupting you, isn't it, in the strategy block?
He usually doesn't interrupt me too much. But what the heck? Let's claim Umbrage on that guy.
I have to invent stuff. He's not here. I have to make him sound like an ogre.
That's
ogre.
Right.
Because we cannot claim any umbrage unless we feel like that we're put upon here as co-hosts of the show.
Yes, for sure.
All right. Well, with that bit of nonsense, we will close the strategy block, and we will roll into. I think we can do an abbreviated mail block.
I think we can.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody, welcome to the Mail Block. This is where you shine. You ask the questions, and we, in our collected years of experience and let's call it marginal, maybe wisdom, try to answer your questions as best as we can. So there's a couple in here that actually are pretty good this week. So let's see what we have going on. So first, the handle is from CJ, and the question, and I thought this was kind of germane to our conversation earlier, is interactive brokers basically being squeezed by pay for play? So Mike, you weighed in before, but maybe you can, if you wanted to, expand a little bit on that topic.
No, I don't think so in that regard. It could be. No one ever really knows what's happening out there in the halls of Congress where deals are being made every day. But I think that they're just looking to go a different direction from everything that I can tell. And I agree with Andrew in that I think they're going to shop it, and I think they're going to make some money when they sell it.
Yes, I can't believe, if not the first or second smartest guy that has traded options is going to let that apparatus just go. I'm sure some fund will buy it at some point. But what I did think was interesting about this is, everything with, especially somebody with that intelligent, that's that successful, would be kind of as a cost-benefit analysis, right? So the market maker operation, I know at some point, was a massive, massive money spinner for Timber Hill for years and years and years. Market making used to be pretty lucrative until it basically got wrecked. But wrecked, I guess, is you could debate that term, but there's not a lot of active individual market makers, although there's some. But for them, they're taking a lucrative business, and they looked at the cost-benefit analysis, and they say, you know what? We're not making enough here for it to be worth the compliance headache relative to our retail brokerage operation. So that, I thought, too, was kind of telling about what what probably one of the older players, if not one of the old, it's certainly the oldest electronic player, decides about the business. I thought that was kind of telling. Maybe there's room for an old guy to go back and try to, pick and choose his electronic markets, like myself. But I thought that was interesting that they would just exit like that, where they just didn't see the dollar for the headache anymore. I thought that was pretty interesting, actually. Now here's another question. I think we can take a couple more questions. I think you can answer this one, Mike, as well. This is from Amy. What is the shortest expiration available for plain vanilla options?
Amy, the shortest one available at this point is 2 days. There's weeklies, and now on a lot of underlyings, SPY included, there are Wednesday options. So they come out couple of weeks in advance, but you could actually either buy, let's say it's Monday, you could trade a Wednesday option that expires in 2 days, or a Friday option that expires in 4 days. So that is the shortest one. I guess technically it would be a one-day option if it was Tuesday, but Wednesday options are up and running, and they're actually very liquid in the SPY world. And I've traded them many times myself so far, and I think I like their existence.
I do too, and I'm predicting within a year maybe we'll probably see daily, like the week of expiration, or let's say the active expiration week. You might have daily options. Daily expiries, I could see that. 'Cause we're almost there anyway, right? Because this week you have, if you're trading the SPX, you've got Monday, Wednesday, and Friday, although Monday is expired and so is Wednesday, but you have 3 days already. It's a short cry just to have 2 more, or a short leap. I would expect, we could start seeing those in Apple. So I think probably they're one of the great innovations of and I think, it's electronic marketplace. There's no way you could have done this old school. There's just too many things to manage. But with increasing bandwidth, that definitely could happen. I remember actually a time where the exchanges were running out of bandwidth. So I thought that would be interesting. Let's see here too. Let's see here. And I think that will close out our mail block, and what we'll do here is I guess we'll roll into around the block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, we close out our mail block, and just because a birdie just sent this to me via the magic of instant messaging. And before we go right into Around the Block, I was just going to test Mr. Tosaw's straddle acumen. So the question of the week is snap options arrive Friday. Assuming snap is 25, what is the 1 week straddle cost? So, Mike, what would you guess the trading population has said so far?
I would say that our audience members, between $1 and $2, I'll say 10%, $2 and $3, 33%, $3 and $4, 31%, over $4, 26%. That's my guess.
That is the most amazing spot on guess I have ever heard. I think I'm going to take all my money and I'm giving it to you, because anybody who can make that sort of estimation is amazing in my book. Amazing.
I have to admit, there's some insider trading going on with that assessment.
There is. See, now if Longo was here, I think he would have taken umbrage to that. He would have accused you of some sort of cheating. But I guess since it's me, I'll just be amazed by how good you are.
I cheated.
So between 2 and 3 for a 1 week straddle is one. And like I said, if the straddle, a 1 month straddle at 100 volatility is $5, if you can believe that, on a $25 stock. So I was guessing $2 or $3 for a 1 month straddle, and that would be a 75 vol. So people are saying $3 for 1 week right now. And I can see, I think that's probably a fairish price, somewhere between 2 and 3. So I think the people, our listeners, the Twitterizers, have done a pretty decent job of estimating that straddle price based on, I think, because the realized vol right now for the first week's about, 125% or somewhere around that. I kind of back of the envelope looked at it. But anyway, that's what we got. So again, what are you looking at here besides that? Well, all I can say is unbelievable guesstimation of our listeners' straddle acumen. What are you looking at, toward the end of the week?
Oh, I think non-farm's the big thing. We're due for a crazy down blip in the market. We have not had one in a while. And by down blip, I'm referring to just something that would happen through our presidential tweet or something along those lines. They're talking about wiretapping now. They're talking about a lot of different things, and we haven't had anything spook the market in a while yet. We've come down, but we have not had like just a sudden drop. And we're due for something. Now, whether it's going to come from a tweet, whether it's going to come from some type of crazy news or whatever it is, I don't know. But I'm on the lookout for that, and just watching non-farm. And then, of course, we got the Fed coming up as well. But tomorrow's a big day at 7:30 in the morning Chicago time. I will be tuned in and watching.
I will as well. Non-farm payrolls. The ADP number was huge, and that gave us a little bit of a boost on Wednesday. I expect this to be pretty good as well. So, I mean, that's about it. And and you're right. We got 100 days without a 1% down close to close. So, an unprecedented, I would just call low vol rally. That's what we have. So, and with that, we will close, our around the block segment. We will close our around the block segment, and then I will poll my co-host. What are you doing, or what can people expect from Mike Tosaw at RCM Capital right now?
They can expect great service. They can expect smiles. They can expect lots of excitement. Even though excitement has no place in trading, it's exciting if someone else, like myself, is doing the trading for you. Feel free to contact me, folks, if you are interested in working with a financial advisor who is not afraid of the word volatility, put option, theta, or rho. I can be reached at 312-212-3531 or shoot me an email at mtosaw@rcmfs.com.
And with that, also myself, at Option Pit, we have our Saturday class on butterflies. The Greasy Meatball will doing directional flies. I will be doing more non-directional flies. Saturday, if you want to learn how to make money with a butterfly, you have to know how they work. So that's what we'll be teaching our Saturday class this Saturday, the 11th of March. And I think we'll thank Mark for letting us hijack his show. And we made a little bit of fun with him, but not too much fun of him as he sips his Mai Tai in some sunny tropical clime on the West Coast somewhere. But we do miss him because he is, I'll grudgingly say, slightly entertaining when he is hosting his show. So for myself, for Mr. Tosaw, for the Option Insider Radio Network, we thank all of you for tuning in to the Option Block, and we will see you all next week.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.